What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is February 19th of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I not only want to spend some time to talk about why I personally believe we're seeing one of the best years for not only Bitcoin, but also for gold and silver in a very long time, but along with that, talking about how we can continue to see a continued rise over the next coming year and the next couple of years if these fundamentals stay the same. And I'll tell you, the topic that I'm going to be talking about today that's causing this is getting little to no media attention, but it's a pretty severe and real issue that people need to account for. All right, so we're going to be talking about that and much more right after our quick sponsor. Our sponsor for today's episode is TaxBit. The IRS recently released new forms in 2019 that require all taxpayers to attest to whether or not they traded cryptocurrencies, no matter if they made gains or losses. TaxBit automates your cryptocurrency taxes, enabling you to effortlessly track, calculate, and report your transactions. Easily connect your exchanges to securely sync your transactions and run them through TaxBit's tax engine. Generate your completed tax forms with a single click. Founded by tax attorneys and CPAs, TaxBit is the most trusted cryptocurrency tax solution. Get 10% off your tax plan today with a free trial using promo code DataDash. Alrighty, everyone, so I want to go ahead and start by saying that the core issue that I believe that's really sparking this rally across these three major assets is something that people not only tend not to pay attention to, but may seem boring on the surface. But when you see the actual numeric value and you understand the ramifications of it, it's a very big issue. And it's one that we've talked about previously on the channel back a couple of months ago. Now, to start though, I want to go ahead and take a look across the board on price action in markets. Now, you guys have obviously probably seen, as we've been talking about on the channel, what's been going on in cryptocurrency markets, not only between Bitcoin, but also altcoins. We can see here very clearly, right, that Bitcoin has been doing very nicely over the last few weeks, coming down from this kind of accumulation period where we were hovering around the upper $6,000, lower $7,000 range, and now we're up towards $10,000 again, above five-digit territory for Bitcoin, and pushing towards a $200 billion valuation as an asset in the case of Bitcoin. All right, so this is really good. The price action is very clear here. We've talked a lot about Bitcoin continuing to go through its logarithmic channel that we've seen over the last 10 years of its history, but I want to go ahead and talk a little bit deeper here. Right? I want to go ahead and dive into taking a look at gold and silver as well. So if we take a look at the price of gold here, right, this is on the daily chart here, we can see that gold has broken out, again, relatively close to its previous kind of highs if you're counting the wicks here. But in this case, if it were to close up here today, it would be setting an all-time relative high for near 6 or 7 years worth of price action, right? We're coming back all the way here to 2013. So over nearly 7 years here, we have not seen gold at these prices, back towards the period of time where, again, there was still a lot of fears around the economy and the previous recession that happened in 2008. So a lot of people were still looking for hedges. And now we're seeing gold come back to that exact same valuation range. But if you take a look on the weekly, it becomes even more clear, right? We can see here, I'll take off the logarithmic chart so you can see my support lines a little bit better. But we can see we're very close back up to this range here. The trend is very clear here. We are obviously in a bull market for gold. And along with that as well, the chart for silver is even more pertinent here, right? Now, if you're looking at the daily time frame, you might not be able to see this, right? Of course, you can see here that, silver has bounced up about 80 cents per ounce, which is really good for a matter of just 5 days. But if you take a look at the weekly, the trend becomes so much clearer. And we've had this chart drawn out for a long time, but again, just take a look here. Actually, we'll take a look at the monthly here to make it even more clear, just to keep it simple, right? We basically have a key support range that historically used to serve as resistance. You also have this resistance range, which we're going to be watching over the next couple of months. But along with that, a descending line of resistance here that came down to rest in this line of support. It was holding down price for a long time. We got above there on a multi-month basis. We made it new support, and now we're curving back up here, right? So you can just kind of see, if you just kind of read the momentum of the chart here, guys, not doing a crazy amount of TA, even ignoring here the SMS indicator, right? Just looking at the price here. What does this tell you here, right? When we're getting above almost near decades worth of resistance here, coming and making it support and setting higher lows and higher highs. That's a signal of a trend reversal. And another simple way to look at this, just to kind of get a clear picture here, if this isn't convincing enough, is the well-known gold to silver ratio. Now, as we'll talk about here, and we're going to actually use it in a way that a lot of people don't tend to use it, or at least a lot of average traders don't, but a lot of institutions tend to. ratios are extremely valuable because we can build ratios between any given assets we want. We could put it with a risk on and a risk off asset, or certain assets to find correlations compared to what we've seen in history. So one of those that I love is the gold to silver ratio, and this one's a little more well known. It's a very simple ratio. It's simply comparing how many ounces of silver you could buy for an ounce of gold. Plain and simple. That's basically what it's saying here. So right now, for example, at the gold to silver ratio, we have 87.816. This means that roughly speaking, you could buy basically nearly 88 ounces of silver per ounce of gold. Right? That's a very simple way to visualize it. Now, what does the ratio tell us when it's at certain levels? The first thing that we should take into mind is that when the gold to silver ratio is high, so meaning the amount of silver in this case you can buy for 1 ounce of gold is at a high value, somewhere between 80 to 100. In this case, it tends to mean that gold in this case is overbought or silver is oversold. You can kind of label it however you'd like, but it usually means that we're at near the bottom of a precious metals market in this case, right? We're at the bottom of a bear market, meaning that there's possibly a lot of room, according to history and according to the ratios history, for commodities to move higher, and specifically silver, right? So we can see here, if we take a look back, right, we tend to find that when we're in this range above 80 points here, and of course we've pushed up a little bit higher this time around, any time around 80 or above, this is where we can start to be a little bit more bullish on silver. And if we were to take a commodity position, I would opt in for silver over gold because there's probably much more price potential, at least according to what history shows us. Now, again, we don't know that to be factual. We don't know if that's going to be true in the sense of this next run up, but at least history shows us this. We have some sense of confidence in the price data. But along with that as well, if we take a look here, we've been setting lower highs and lower lows here in the sense of the gold to silver ratio. Now maybe here in the short term we've been setting some higher lows here and higher highs if you want to look at this, but if you're taking a look at the longer term kind of highs here, right, we haven't been able to get back above here what we were holding back in July of 2019. And along with this, we've been building an ascending wedge, which is actually a bearish pattern where you have lows that are rising faster than the highs in this case, and it's coiling in and squeezing on the price, where inevitably we tend to find that once we've squeezed in through here enough, right, we eventually get a breakdown, we start to move lower, right? So this is not only true for the gold to silver ratio, this is just a general technical analysis pattern. And I think honestly it makes sense here at this point, guys, to start finally seeing this breakdown and continuing lower, meaning that silver is really probably going to start picking up here. And that's not to despair gold, right? I've already shown you guys the gold chart. I think gold is doing great, but it means that silver is going to dramatically, it's likely to dramatically outpace what gold does over the next year or two. So as we go into a precious metals bull market over the next year or so, we're going to be seeing silver do even better than gold. So this is our target range. This is the range where we usually want to consider that the precious metals market is getting overextended and that we want to look for other assets, probably equities now that they'd probably pulled back by that time, or maybe look at cryptocurrencies or property markets or other kinds of other types of commodities, whatever it may be, right? But there's another thing to take into mind as well. I think a lot of people have been looking at equity markets and like, Nick, you've been kind of avoiding equities since 2018. Markets have moved up about, give or take 25% since your call back in the top of 2018. What do you have to say for yourself in this case? Equities have still been rising. Well, to be fair, guys, yeah, I think I made a premature call in this case back in 2018 about being bearish on markets. And when the fundamentals changed in the sense of the Fed monetary policy, where they actually started to continue adding things to the balance sheet, the Federal Reserve started adding assets to its balance sheet. And again, injecting more liquidity into the system through repo markets, then in that case, I flipped my position because the fundamentals changed, and that was earlier in 2019. But putting that aside, let's just go ahead and take a look at how gold and silver have compared to equities. Well, gold has actually been outpacing equities. Now, how do we know this? Well, we can not just take a look at the gold chart, but along with that, we can do a ratio, just like how we do with the gold to silver ratio. We can compare assets like gold to broad indexes like the S&P 500, which measure the performance of equity markets, of the stock market. And we can see that just like back here, between 2002 and 2005, we have got a technical pattern building up for a monstrous cycle here. So what are we seeing here? Well, we're seeing an ascending triangle. This is a bullish pattern, no doubt. We can see here that we have higher lows, we have a consistent resistance range, and above all, right, if you want to avoid TA in this sense and just look at simple kind of price level analysis, the higher lows here proving that we're getting better performance here in gold compared to the S&P 500 is already a great sign as is. To just keep it simple, right? Again, we're not using any crazy technical indicators, but we're doing two things. We're looking at long-term time frames, and we're looking to see which asset is showing strength within the ratio. And because gold is the first asset in the pair in this case between the gold and S&P 500 ratio. And in this case, the higher lows are telling us that it's outperforming the S&P 500 over the last year and a half. So this is really interesting to see here. And of course, if you factor in these kind of shorter periods where we're really starting to see an increase in the ratio, then in this case, I mean, those are even better periods, right? But I'm just generally talking about the trend shift here, right? Because we do have some pullbacks here where equities have come back, right? What we care about is not the bouncing around in price here. We care about the breakout out of the technical pattern that sparks a cycle where gold out-ratios equities by a mile, right? We can see that the ratio in the past year grew exponentially because during this time period, we had equities selling off. So gold was a better asset in this case because it wasn't selling as fast as equities. And along with that, the continued rally in gold as we started to go into 2009, 2010, and 2011. So again, that's what we're looking out for here, to see gold react and act as that store of value during times of chaos. Another chart as well, very similar layout here, but a little bit more simpler. The higher lows here that we saw in silver, that again were the initial steps before we started the next cycle compared to equities. We're seeing the exact same thing here in the sense of this cycle. We're seeing higher lows here and higher highs. It's exactly what we want to see for a trend reversal to showcase that buyers are coming in at earlier levels when we have these pullbacks, and along with that, that it's outpacing equities, right? So that's the key thing to take into mind here, that we are already outpacing equities in one of their best years back in 2019 and even in 2020 where equities are doing great so far. So these are the things to take into mind. And one thing I just want to share, guys, again, I don't try to make these things overly complex, and I try to share a lot of free material here on the channel. But we've talked about this on our newsletter. We talked a lot about the overextension in equity markets, but even with that overextension and the likelihood that we will see some kind of pullback as we enter into NASDAQ 10,000, as we enter into a doubling of the valuation of tech stocks from where they were back during the dot-com era, we talked about what's been going on in commodity markets, how commodities as well as cryptocurrencies are the places to be positioned. And as much as you see these big numbers in the S&P 500 and the Dow Jones, the NASDAQ, and the Russell 2000, these have been the best performing markets. We're in the money, big time. And that's not bragging in any way. It's just simply keeping in mind that we're following the trends, we're following the ratios, and we're looking at things a little bit different than most people would probably look at them as, right? So again, I would recommend, if you guys want to support the channel, a newsletter is a great way to do that. Again, I write it myself and stuff. It's been a really fun time doing it. I can't believe it. I think it's been over a year and 3 months now that we've done it. It's pretty wild. But anyways, it's been a fun journey. Now, I want to go ahead and talk a little bit about what's causing this growth, right? What's causing gold and silver to be able to not only be profitable assets, but even outpace equities in one of their best 2 years that they've had in a very long period of time. Well, it has to do with one singular thing, and that has to be negative yielding bonds. Okay. Now, there's a lot of macro factors I think we could agree they're playing a role in gold and silver. It could be small, kind of sporadic things like the coronavirus. It could be the trade war. It could be all kinds of different macro factors. But if you think about it, a lot of those macro factors have kind of cleared up. Trade war is getting settled to a decent degree. Brexit has been resolved and is now basically resolved with the UK leaving the EU. And now we're really having to look about what fundamental things are still persistent and possibly are growing worse. One of those things is negative yielding bonds. Whereas for a multi-month basis, this is the month-by-month change here. Actually a week-by-week change. We actually had a very large decline here throughout a lot of 2019 where we saw a reduction in this case. Oh no, sorry, I think this is by month-to-month basis. I don't know, might be miscounting this, guys. I apologize, but we can see here in this case that from back here. Oh no, sorry, this is where 2019 starts, so it is weekly basis. So we can see the weekly changes here in the sense of negative yielding bonds increasing or decreasing. And over the last few months, we actually decreased a decent amount, but we just had our largest increase of negative yielding bonds in the past week. Excuse me, I think this was back in sometime in January of 2020. The largest increase from the data we have since as far back, I'll try and get the actual date here. I think it was as far back as 2016. So now it's looking like we might be joining back on the trend of more negative yielding bonds. It looks like the yield of these bonds across the world between the European Central Bank as well as a lot of the Japanese government bonds in this case are starting to yield a negative bond. The federally issued bonds in this case are starting to see more negative yields in not only European markets but also in Japan. And eventually, I have a belief it's going to be in every single economy because we're all playing the same monetary policy game. It eventually gets to this point. It's just that a few players are ahead of a few other countries in this process. And if you don't believe me, guys, this is the final chart here. I'm not showing you guys anything else today. This is it. Take a look at this right now. If we take a look specifically at gold, a more established, well-known store of value, gold has had a direct correlation with the growth and increase in negative yielding bonds. Right. So again, I want to make sure I make it clear the ramifications of this because I know some of you might not know what I mean by negative yielding bonds. Because honestly, when you hear it for the first time, it's not going to make much sense. It is basically a government asset in this case, basically an IOU from the government. Whereas originally in a bond, a government in this case would pay you interest to hold because you're giving cash up in the short term to fund government expenditures. In this case, they're giving you an IOU that has a monetary value, basically the actual underlying value of the bond, but also you also get interest on top of it. You get a yield, right? But here's the thing. In the world of negative yielding bonds, in the twilight zone that is the modern economy, there are now negative yielding bonds, which mean you pay the government. Think about that. Where in a negative interest rate environment, right, where if you have money in a bank account, you are paying the bank to store your money and lend it out for interest. It doesn't make sense. It really doesn't. And in this case, we really need to take precaution in this case to realize that going from $10.9 trillion in negative yielding bonds to $13.9 trillion is no laughing matter, and it's not something that can be ignored. And the market is reflecting that. If you don't think that gold, silver, and yes, even Bitcoin are starting to show this, then we're not viewing the bigger picture, right? This is it right here, guys. It is basic understanding of monetary policy, of the failure of central banks to be able to follow any kind of logic in their way of thinking and managing the creation of new money. Because this is inevitably what happens, right? We get to this later phase here that will inevitably lead to the depreciation en masse in valuation of fiat currencies. This is how it happens, right? Again, no one wants a negative yielding bond. No one wants to finance the debt of a government that's going to make them lose money. The only reason these numbers are growing is because they are mandated to hold these. There are people who manage the portfolios of people's retirement accounts. There are standards federally that make sure that they have to hold some allocation of government bonds in people's portfolios. Now, for right now, it's not a big issue because you've got equity markets that are going up. You've got central banks injecting cash into the economy, and it's still at a level where they can get away with it. But the issue derives at the point where you can no longer offset the guaranteed loss of paying the government, in this case, to basically hold these bonds with your previous returns in other markets. So when your returns in equities and your other asset prices go down enough, and that negative yield is starting to crush people's portfolios, people's wealth en masse is going to depreciate. And as we can see here, it's in the tune of trillions of dollars. And this problem is only going to get bigger. Okay? So anyways, I've rambled on enough today, guys. If you like this video, definitely drop a like. I always appreciate it. And if you have a comment or something to say about this topic, whether you agree or disagree, leave it down below in the comments. I want to hear from you guys. But again, this is a very, very interesting macro topic. And quite frankly, I think you guys would probably agree with me. I don't think anyone's talking about this, right? Because negative yielding bonds kind of lost their kind of buzz when we kind of peaked out around 17 trillion and we came down to 10 trillion. Oh my God, what a better world. We reduced it by $7 trillion. Yeah, that's true. It is an improvement, but it's still $10 trillion of assets that are yielding a negative return. Now I can tell you what isn't yielding a negative return and what does hedge against mass inflation: gold, silver, and Bitcoin. These are the assets that are going to lead the next decade, in my opinion. And I'm happy to be on this journey with you guys. But until the next video, thank you all so much for watching. I hope you all have a fantastic day, and I'll see you all in the next video. Stay tuned.